Right, we will get started. Thank you so much for joining me this morning for our 2025 Fiduciary Training 201. So we've split up this content this year into 101, 201, and 301. Today we're going to cover hot topics for fiduciaries. My name is Jenna Witherbee. I'm one of the advisors on the team at 401k Plan Professionals. If you are not familiar with our team, we are an advisory team that focuses on retirement plans. And we spend all of our time helping plan sponsors and participants inside 401k and 403b plans. So this is a part of our quarterly fiduciary training. Like I said, this year we're doing it a little bit differently where we're splitting it up into 3 different sections. This will be 25 minutes, plus I'll leave some time for Q&A at the end. Our 301 training will be in October. So towards the end, I'll show you the QR code to register for that. And the recording will go out. So if you need to hop off for whatever reason or want to rewatch it, want to forward it to somebody that you think may find value in it, feel free. You're going to get that recording automatically. And then this training plus all of our other previous trainings are out on our website, 401kplanprofessionals.com, as well as our YouTube channel. You will also get a fiduciary guide that goes along with the content that we're talking about that has a checklist inside of it. So that's another value add. In February, we covered 101, your role as a fiduciary, the basic responsibilities, best practices, and educated and empowering participants. Today, we're going to focus on the hot topics. This is an ever-changing industry landscape. We're going to talk about what is top of mind for us and for plan sponsors in this industry. And then, like I said, our next training will be in October. And actually, here's the QR. If you're not registered yet for the 301, you can go ahead and do that now. So today we're going to cover, like I said, the hot topics. I actually have a poll that I'm going to launch. If you could please answer these 3 questions. So I have a lot of content and I want to know kind of where to spend the most time today. So how interested are you in learning about legislative updates? So that's specifically the Secure 2.0 legislative changes that are coming. How interested are you in learning about pooled employer plans? And then lastly, how interested are you in learning about ways to build participant financial confidence through education? So I'll just give that a moment here. This will help me, like I said, just kind of know where to spend the majority of my time this morning. All right. So definitely looks like legislative updates and the employee education are the topics you want to hear the most about. And then I'll just briefly touch on the pooled employer plans. Okay, so hopping into the legislative update, the Napa Fly-In Forum is on its 13th year, and this is where top retirement plan advisors go to DC and they engage with the federal policymakers to advocate for policies that are affecting our industry and what's making it challenging, what we're wanting to see, things like that. And so with this information, plus just in our day-to-day practices, I'll tell you an update on Secure 2.0, looking ahead to Secure 3.0, litigation, and state mandates. So here's kind of the main, I would say, changes that are coming or recent reminders with Secure 2.0, which was a huge piece of legislation passed in late 2022. So we're going to cover these 5 main categories. So first is the Roth catch-up for high income earners. This is a rule coming January 1st, 2026. It was going to be effective January 1st, 2024. They gave us a 2-year extension on that, which we're really happy about, just so providers, record keepers, payroll companies can be ready for this change. But this is where certain individuals will have to make their catch-up contributions on a Roth basis, after tax basis. And this is mandatory. So this is not something plans can choose to do or not. This will affect all 401k plans. Who is affected? Catch-up contributions for workers with FICA wages of 145,000 or more in the prior year, so it's a year look back, must have catch-ups deposited as Roth. And that 145,000 figure will be indexed up, by the way, each year. Now, there's some payroll mechanics there, right? Which we're still kind of, oh, 1 second. Sorry about that. Still looking for some payroll company kind of guidance. How are you going to handle it? Are you going to automatically change people from pre-tax to Roth? Are you going to communicate with them? Hey, I'm going to change you. That fourth bullet point, if there is an error, if something does need to be recategorized as from pre-tax to Roth, they are going to make that easy for fixes, and that individual will get a 1099 form. So as we're getting closer to this January 1st effective date, we've been talking with plan sponsors, making sure they're communicating with their payroll company and just being in the know of how it's being handled, the mechanics of it. It's nice that it is a year look back. So at the end of this year, you can look at FICA wages and know, okay, who is this even going to impact? And then it will impact them only if they get to that catch-up contribution. So that's a pretty big one coming. This one's optional, so distributions for emergency expenses. Employers may allow distributions up to $1,000 for certain emergency expenses. This can happen one time in a 3-year time period. This money could be repaid, but essentially this allows participants to take out up to $1,000 with no penalty, no 10% early withdrawal penalty. The employee can self-certify that they have this need. It's more lenient than hardship rules. However, it is limited to that $1,000. This could be better than some alternatives for individuals. This is something that some record keepers aren't set up for on their systems, but this is an optional provision that we will be seeing soon. Another one is long-term part-time employees. This may pertain to you and it may not. Some companies just don't have any part-time employees, or if they do, they know they're never going to hit this hours requirement, but I do want to make sure you're aware of it. So part-time employees who work 500 hours or more in 2 consecutive years must be allowed to contribute to the 401k. You don't need to match them or give them profit sharing necessarily, but they need to be offered the plan if they want to save their own money. And Secure 2.0 shortened this requirement from 3 consecutive years to 2 consecutive years. So this is something too we've been mentioning as we go. Every plan design, is a little bit different. So take a look at, do we exclude part-time, temporary, seasonal employees right now? Do we have anyone that falls in that boat? And just be mindful that you may need to offer the plan to some of your employees if they meet those requirements. Retirement savings lost and found. This is something that is not a high priority with current administration, but there's talks of we're going to create a national database for Americans to find lost retirement accounts. So as people change companies and move, it can kind of get messy with accounts that are lingering out there. And if plan sponsors don't have their current address, email address, phone number, they can essentially lose these employees. So a system, a database will be created and maintained by the Department of Labor. This will need some data input, which we don't know what that looks like right now, but hopefully coming soon. Matching of student loan repayments. This is something pretty creative. This is completely optional, but this is where employers may opt to match contributions towards an employee's qualified student loan payments as if they were salary deferral. So if you have staff that tend to have a lot of student loan debt, and maybe you're even seeing they're not participating in the plan or they're not saving very much because they're paying a lot of student loan debt over here, you could have a solution with your record keeper or perhaps an outside vendor that are simple to use. And if an employee can certify, hey, I'm making these qualified student loan payments, the employer can um, use that as their contribution and then can give them a matching contribution into the plan. Pretty unique, and it needs to be the right fit, but we are seeing more and more adoption and at least more conversations around this. Um, there are some mechanics there, employees need to show or disclose, yes, I am making these student loan payments. They must be given at least 3 months after the close of the plan year to claim the match. And this can benefit the employer by recruitment, retention, it's tax deductible and budget neutral. We just last week actually did a webinar, a deeper dive on this with a company called Thrive. They have some pretty unique, they'd be an outside vendor, but they have some pretty unique solutions regarding the student loan accounts, even 529 savings, emergency savings, health savings, that employers are looking more and more at. So here's an example. If you have a plan that has a match 100% up to 5%, we have 3 different people here. You have Bobby, who is saving 5% into the 401k. Of course, they're getting their 5% match. You might have Leon that has pretty hefty student loans. They're making their payments, at least 5% of their pay to the student loan payments. They're getting the 5% match in this arrangement. And then lastly, Sylvia is kind of splitting, right? 3% and 2%. So we're seeing, just a little more creativity, I would say, when it comes to benefits and matching. All right, so the amendments themselves. Technically, your 401k plan document must be amended for these mandatory and optional provisions with Secure 2.0 by the last day in 2026. This was extended from 2025. So people like us and plan sponsors and record keepers are very happy about that, just to get a little more time on that. Now, you may change things operationally, and there may be documentation and forms and online forms that your record keeper has to know, are you opting into this or not? But from a legal standpoint, that plan document doesn't need to be amended till the end of 2026. So retain all documentation of adoption of any of these provisions. Like I said, with that emergency expense, that one's not quite ready yet, we're finding with a lot of vendors. So some of it is a little bit of a wait and see, but we've been kind of working through these Secure 2.0 changes over the last couple of years. So now it's always changing, and we're thinking about Secure 3.0. What's the next wave going to look like? And we don't know time-wise. There's no timeline with any of these things, but number one, analyze the impact of Secure 2.0 provisions like the super catch-up, the Rothification of the catch-up for certain individuals that I talked about, all these enhanced distribution options. Number two, consider the Roth IRA to 401k rollover. So right now, it's problematic because if you're in a 401k and you roll your pre-tax money to a traditional IRA, it can come back in a 401k environment. But with Roth 401k, if you roll it out to a Roth IRA, right now the rule is that can't come back, that can't be rolled back into a 401k. So we're finding that to be problematic as Roth becomes more popular, as accounts are being forced out under $7,000, as we are seeing more of these lost retirement accounts. We're saying that we'd really like the rules to match, that you can roll Roth IRA money back into a 401k environment. So hoping to see that, hoping to see a streamline of plan-to-plan rollovers. There is already a network of certain providers that have created this kind of auto portability. So for instance, if I leave a company and I have $5,000 in my 401k, normally I'd be forced out eventually at that account balanced. I'd be rolled out automatically. But if I join a new company and they have a 401k, this auto portability system will know, okay, Jenna's over here now. There's mechanisms where my $5,000 401k can automatically be ported into my new 401k. Now, not all providers, not all record keepers are a part of that yet, but I think there's about 7 or 8 providers that are a part of that now, and plans would have to opt into this auto portability network, but hoping to see more adoption there. It's just going to make things easier in our industry as people change jobs and there's a lot of moving parts with accounts. Just get things consolidated together. And that would only pertain to those under $7,000 balances that would be otherwise forced out. Guidance on fiduciary responsibility to those lost participants that I talked about, and then allowing employees age 18 to 21 to participate in plans. There's been a lot of litigation surrounding forfeiture dollars. So if you have a vesting schedule with a match or a profit sharing contribution, you may have these forfeiture dollars that are building up as people are leaving your company, changing jobs, and some of their match or profit sharing is forfeited. So as it stands now, you're supposed to use those forfeiture dollars in that plan year to benefit those plan participants and not carry over too much of a balance. And there has been some lawsuits filed in the last couple of years surrounding that. So some of these lawsuits are alleging that the use of forfeitures to offset future employer contributions violates ERISA provisions. Maybe they put the employer's financial interest over the best interest of participants. So it's not a bad idea to take a look at your plan document, how it pertains to forfeiture dollars, how those can get used, and try to use those year over year so you're not carrying too much of a balance. Okay, briefly on state mandates, and this is the pooled employer plan part. I'll just kind of breeze through this. So some states, Minnesota now included, have a mandate saying that certain employers need to offer their own retirement plan or they can use a state plan. So 1/1/26 is the effective date of the Minnesota mandate. Employers with 5 or more employees will have to have their own 401k, or they can use the state plan called Minnesota Secure Choice. That was supposed to be effective in 2025. It was delayed to 2026. So we know now that a lot of Minnesota small business owners are going to be thinking about their options. Do we want to go with the state plan? Do we want to have our own plan? And so we created, it's called the 401k Collective. It's a pooled employer plan where you can basically be a part of a group of plans and have some cost efficiencies and just ease of administration. Many states have either already passed mandates surrounding this or are thinking about it. So the purplish color, those states have enacted mandates. Blue and orange are kind of in the works, and black have not made any efforts towards this. So essentially, the key takeaways with a pooled employer plan is you can join together with multiple other plans to create kind of one big retirement plan. This can be advantageous for all sizes of plans. It really reduces the administrative and fiduciary liability. It's cost effective, and we feel it is a better solution for some employers than the state mandate plan. The state plan will be more like an IRA type plan. Your limits are much lower than a 401k environment, and there's not as many you can't get as customized with the plan design. So the benefits of our pooled employer plan, you still work with us, we still do all the education, we hold the investment reviews, and it can be a really cost-effective solution. Now, if you're a current client of ours, you might be thinking, well, should I move my plan into this? Should I do this? We can benchmark it and look at our pooled employer plan just like we would benchmark any other provider. In some cases, there is cost savings, and in some cases, there may not be. So we'd have to look at your specific plan, but it will be a really great fit for new plans that need a home. So as far as the lift on you as a plan administrator, you of course need to submit contributions, but a lot of the administrative burden falls either on us as the advisors or our pooled plan provider. So taking care of all the administrative things, tax filing, any audit requirements if you have one. Okay. And by the way, we are doing kind of a deeper dive on the pooled employer plan in August. So lastly, wanted to touch on employee education. So building financial confidence through education. We are seeing more and more automatic features being added to plans. So not only automatic enrollment, which we are finding that a lot of employees even expect to be automatically enrolled now because it's so prevalent in our industry, but also we're seeing features like automatic increase being added to plans. So this is from a Fidelity Plan Sponsor Attitude Survey. Every year they survey over 1,000 different plan sponsors, and 28% said adding automatic increase is an initiative of theirs, or was an initiative in the past 12 months. And then looking ahead, 32% said they wanted to add automatic increase to their deferral rate. So now that a lot of plans have the automatic enrollment feature, kind of looking to that next thing with automatic increase. And if your plan doesn't have auto increase on a plan level, just to let you know, most record keepers, most providers will let individuals opt into auto increase. So here's the screenshot from one of our plans online. This is what a participant sees. This is the interface. So they can set on their account, automatically increase me by X% until I reach X% and do this every July 1st or whatever date they want to set. Also, we've been talking a lot about health savings accounts. They can be a really powerful tool for not only saving for future and current medical expenses, but even in retirement being another pool of money, because after age 65, you can use HSA money on anything. If it's non-medical, you just have to pay regular income taxes. So we've been kind of weaving in HSA education with the 401k education. We have a continued emphasis on overall financial wellness. We know firsthand from talking to many participants over the years that if they feel better about their finances, they're going to feel better about a lot of other aspects of their life: physical, mental, emotional, social health. So we take kind of a comprehensive overview when we're talking wellness. And we see employers really grasping onto this concept as well, because when their employees are feeling less stressed financially, they are more focused, they are present at work, they're more productive, and it affects other parts of their lives. With our financial wellness series that we've created in-house, we've expanded it to include a financial wellness worksheet, so it kind of goes alongside our 8-step videos. So that's been something we've been seeing more of, growth of AI. This can be things like when we do our one-on-ones, there's note takers. It's helping summarize conversations with people. So kind of on the beginning stages of that. We've been still doing a lot of our one-on-one sessions, whether it is slated days that we set up for particular plans. Hey, these are the 3 days we're doing one-on-one meetings for you. Or we have something called office hours, where we have a couple standing dates every month where participants from any plan can sign up to meet with us for 30 minutes. And this is just from last year. These are some of our top participant meetings at these different companies. And a couple of these, by the way, don't even really have a lot of brick and mortar. Their staff are all across different time zones, different states. And so we've been really pleased with our virtual meetings and how we're able to reach more people. And the last thing I'll say here is everything's very customized. Every company is different in terms of their demographic and their needs and their objectives and just what works best for their staff. So we've done a lot of different things when it comes to employee education, and we're always happy to work with you and tweak it to what works best. Okay, like I mentioned, we do have our YouTube channel. All of our past webinars are out there, as well as that financial wellness series that I mentioned. When you exit out of here, you're going to get a survey. And one of the questions is if you want to take this course, this Fiduciary Essentials for Defined Contribution Plans. We pay for it. You get a code, and it's a program that'll bring you through sessions and quizzes, basically to just further solidify your understanding of your fiduciary responsibilities. And there's some other additional resources that you get with this credential as well. All right, if there's any questions, you can drop them in the chat. This will be out on our website, like I mentioned, and our YouTube channel, as well as our previous webinars. Someone had asked, how granular do you offer for the auto increase? Is it always a full percentage point? Yes, typically you have to move up by a full percentage point. It varies a bit by record keeper, what they will allow, but 90% of the time you've got to do a whole percentage point. Yep, great question. Some plans allow for a specific dollar amount that individuals want to save, so there you're able to get more granular, but many just allow percentage. So here's a look at our other 2025 webinars. Next month, we have one of our more popular ones, Social Security 101. Like I mentioned, we're doing a deeper dive on pooled employer plans in August, as well as our Medicare 101 in September. This is for participants kind of surrounding strategies for better investment decisions, our fiduciary training 301 in October, and our 8 steps to financial wellness. We'll do a deeper dive on that in November. Thank you so much for your time this morning. This QR will take you to register for some of the upcoming webinars. If you have any questions, feedback, there's my phone number and my email address as well. Thank you so much. And